I'm Dr. Jeff Jones, and in this video we are going to look at the solutions for the first part of exercise 3 of the comprehensive practice set in the accounting review booklet. So this is part 1 of 2. If we take a look at exercise 3, what the setup of the problem is, it says FGB Corp was founded on January 1st, 20X1. On the day of its founding, 20,000 shares of common stock with a par value of $1 per share were issued at $50 per share. In addition, FGB issued a note payable due in 10 years to the local bank in the amount of $1 million. The note payable has an interest rate of 6%, and interest is payable annually. FGB makes all necessary adjusting entries and prepares its financial statements monthly on an accrual basis. FGB uses a perpetual inventory system, does not offer any sales discounts, and all credit terms are net 30 days. So what's really going on in this problem is we have a new company that's being founded. And one of the first things when you're founding a new company is you have to raise the initial financial capital. And so that's what FGB Corp is doing here. They're issuing new stock and they are issuing debt. So exercise 3.1 asks us to prepare the general journal entries related to the founding of the business. And so we're going to have to prepare journal entries to reflect the fact that they are issuing new stock and issuing new debt. So when they're raising new financial capital, generally you're almost always debiting the cash account. So for our first case, we're going to debit cash for $1 million, and then we are going to credit common stock. Okay, the common stock account, we issued 20,000 shares, and those shares had a $1 par value. So what gets recorded in the actual common stock account is the par value times the number of shares outstanding. The difference between those two is going to be credited to an account called paid-in capital in excess of par value, and this is going to be related to the common stock account. And so the difference, $980,000, goes as a credit entry into that account. Now again, how did we get the overall amount raised from equity? Well, the shares were issued at $50 per share, and so 50 times 20,000 shares issued gives us this $1 million. Okay, so that's what gives us the $1 million. Okay, now to record the issuance of the debt. So again, we are collecting cash of $1 million by issuing the $1 million note payable, and we will credit note payable in the amount of $1 million. Exercise 3.2 then asks us to go through and journalize a series of 16 different transactions that occurred during the month of January 20X1. And so that first transaction that occurred on January 1st is that we purchased a 1-year insurance policy for $6,000 cash. All insurance is recorded as prepaid insurance when purchased, and adjustments for expired insurance are made monthly. So we are basically, as a consequence of this transaction, going to debit prepaid insurance for $6,000 and credit cash because we use cash to purchase this insurance policy. Our next transaction, which occurred on January 2nd, we purchased a building for $800,000 cash that will be depreciated over 20 years to a salvage value of $80,000 using the straight line method. And so here again, we're using cash to acquire another asset, so we're going to debit building for $800,000 and then credit cash for $800,000. Our next transaction on January 3rd, we purchased equipment for $600,000 cash that will be depreciated over 10 years, and there's no salvage value on this equipment, using the straight line method. And so this is going to be very similar to the previous transaction, only instead of debiting building, we're going to debit equipment for $600,000 and credit cash for $600,000. Next up is a transaction on January 4th where we purchased inventory of $200,000 in paid cash. Again, we would debit inventory for $200,000, credit cash for $200,000. On January 7th, we sold $50,000 worth of goods for cash. The cost of the goods that we actually sold were $40,000. And so anytime we sell our inventory, okay, in the ordinary course of business, there's going to be two components to the journal entry. The first component is the revenue recognition component, okay? And so basically we're going to recognize sales revenue of $50,000. We would credit sales revenue, and we would debit cash because this is a cash sale for $50,000. The other part of the journal entry is going to be related to what is the cost of the goods that we sold. And so in this case, we're told that that's $40,000. So our debit would be to cost of goods sold for $40,000, and we would credit our inventory account. So in other words, our inventory account is an asset, and so by crediting that, we are reducing our inventory, which is appropriate since we actually sold those goods. Okay, our next transaction occurred on January 14th, and we paid $10,000 worth of wages that had not been previously accrued. So in this case, we're going to be using cash to pay those wages. We would debit wage expense for $10,000 and credit cash for $10,000. Next up, on January 15th, the company announced a cash dividend of 50 cents per share to be paid at the end of the month, and we recorded the declaration of the dividend on January 15th. So basically, when we announce a dividend, we've essentially created a liability for ourselves. So we are going to debit dividends for $10,000, and the credit side of this entry is going to be to dividends payable for $10,000. Next up, on January 16th, we sold $100,000 worth of goods on account. Okay, the cost of the goods were $70,000. The only difference between this transaction and our previous sales transaction is the fact that instead of selling the goods for cash, now we are selling the goods on account. So we're extending our customer credit. So we're going, instead of debiting cash, we're going to be debiting accounts receivable for $100,000, credit sales revenue for $100,000. And then, of course, the second part, the second journal entry associated with this, is related to the allocation of the expense. And so we would debit cost of goods sold for $70,000 and credit inventory for $70,000. Our next transaction on January 17th, we purchased inventory of $300,000 on account. So we would debit inventory for $300,000. But since we purchased these on account, the credit part of this entry would not be to cash, but instead to accounts payable. So here we're basically creating a liability and using that liability in order to purchase more inventory. Our next transaction, January 19th, we sold $80,000 worth of goods on account, and the cost of the goods were $60,000. So this is similar to a couple of transactions ago. We would debit accounts receivable for $80,000, credit sales revenue for $80,000, debit cost of goods sold for $60,000, and credit inventory for $60,000. Okay, then on January 29th, we received a utility bill of $1,000 that FGB Corp anticipates paying on the last day of the month. So basically, we're going to go ahead and recognize utilities expense. So we would debit utilities expense of $1,000, and we would credit utilities payable because we're going to pay this bill in just a couple days. Also on January 29th, we collected $75,000 on account related to the sale that we made on January 16th, which was a credit sale. And so in this case, we are going to debit cash. We're collecting cash for $75,000, and we would credit accounts receivable. So by doing this, we are essentially reducing our accounts receivable balance and recognizing the fact that one of our customers has paid us for the credit that we extended them. Okay, on January 30th, we paid $160,000 on account as partial payment for the inventory purchased on January 17th. So again, this is kind of an opposite transaction from the previous one. Here, we actually had a liability, and we are paying off that liability. So we are going to reduce accounts payable by $160,000. So we debit accounts payable for $160,000, and our credit is going to be cash. So we're using cash to satisfy a liability. January 31st, we paid wages of $15,000 not previously accrued. This is going to be a debit to wage expense of $15,000 and a credit to cash for $15,000. Also on January 31st, we paid the utility bill of $1,000 that we received on January 29th. And so basically we're going to eliminate the utilities payable liability that we created. And to do that, we are going to have to use cash. So we're going to debit utilities payable for $1,000, credit cash for $1,000. And then finally, on January 31st, we also paid shareholders the cash dividend of 50 cents per share recorded on January 15th. And so again, this 50 cents per share times 20,000 shares is going to be an amount of $10,000, but we are going to debit dividends payable because we've already reflected this in the dividends account. So we're going to satisfy this liability, dividends payable, and to do that, we're going to use some of our cash. So again, debit dividends payable and credit cash. So this takes us through exercise 3.2. Let's move on now to exercise 3.3, which deals with adjusting journal entries. And so just as a refresher, adjusting journal entries are basically those that occur at the end of an accounting period in order to make the accounting system reflect accrual basis accounting. And so we're basically going to have 3 adjusting journal entries that we need to make. The first is related to the accrued interest on the note payable. Okay, if you recall, we issued this note payable. Interest was paid annually, but after 1 month, we need to recognize 1 month's worth of interest expense, even though we're not actually paying any interest in cash. Okay, we're not using cash to pay interest expense. And so basically, 1 month's interest would be our $1 million note times 6% times 1 over 12, or if you prefer, divided by 12. And so that's going to be $5,000. So we need to recognize $5,000 worth of interest expense. And so to do that, we would debit interest expense for $5,000. But since we're not actually using cash to pay this interest expense, we won't do that until the end of the year because interest on the note is paid annually. We would credit an account called interest payable for $5,000. So that's our first adjusting entry that's necessary. The second, on January 31st, we would need to record the use or the expiration of prepaid insurance. And so if you recall, we basically had paid for a 1-year policy for $6,000. And so 1 month's worth of insurance would be $6,000 divided by 12, or $500. Okay? So we would basically debit insurance expense and credit prepaid insurance for $500. So that's the adjusting entry that would be required to reflect the expiration of 1 month's worth of insurance. Finally, we would need to record depreciation on the building and equipment. And so let's do the building first. 1 month's building depreciation. If you recall, the building was acquired at a cost of $800,000. It had a salvage value of $80,000, a 20-year life, and it was depreciated over 20 years using the straight line method. Okay, and so basically, to get 1 year's worth of depreciation expense, we would take the acquisition cost minus the salvage value divided by the number of years. That would give us 1 year's worth of depreciation. But since we're looking for 1 month's worth of depreciation, we need to take that times 1/12, and so that's going to be $3,000 per month depreciation related to the building. For the equipment, recall the equipment was acquired for $600,000. It had a salvage value of 0. It had a 10-year life, and they also used the straight line depreciation method. So we simply divide by the useful life, and then again take that times 1/12. 1 month's worth of equipment depreciation is going to be $5,000. So to record these entries, basically the debit side of the entry is going to be depreciation expense. So for the building, we would debit depreciation expense for $3,000. The credit side of the entry is going to be accumulated depreciation related to the building. Okay, so and again, this accumulated depreciation account is a contra asset account, and specifically, accumulated depreciation for the building is it's contra to the building account, so it offsets that account. Now for the equipment, the accounts are going to be very similar. Debit depreciation expense for $5,000, but instead credit accumulated depreciation related specifically to the equipment. So it's appropriate to lump all depreciation expense into one account, but it's not appropriate to lump accumulated depreciation of specific assets into one account. Okay, so each specific asset would have to have its own specific accumulated depreciation account. So that takes us through the adjusting entries that are necessary in exercise 3.3. Let's move on now to exercise 3.4, and here we're going to be looking at the creation of what's called a T account. And you can think of a T account as basically the purpose of a T account is to aggregate all of the journal activity for a specific account. So in this exercise, we're going to create a T account for each of the following accounts. So here are all of the asset accounts that we've used in our practice exercise so far. Here are all of the liability accounts. Here are all of the equity accounts. And then finally, here are all of the revenue and expense accounts. So these are basically all of the accounts that we've used throughout this practice exercise. And so what we're going to do, essentially, is for each transaction that affects a specific account, for example, on January 1st, we had the issuance of stock for cash, which basically that led to a debit of $1 million to the cash account. And then on January 1st, we also issued debt, which also gave rise to a $1 million debit to the cash account. We are going to go back and look at each journal entry that was made and aggregate the results for a single account into these T accounts. So I'm going to move through the cash account here. And you can go back and tie, if you have a question about a specific transaction. But basically, here are all of the transactions that occurred related to the cash account. And so the aggregate effect of that is that as of the end of the period, as of January 31st, the balance in the cash account should be $323,000. Okay? Now, so that's the process that you would go through to create a T account. You would simply do this for every other account. So we can do this for accounts receivable. Notice in this case, right, we have some debits, some credits. The aggregate balance is reflected here. So basically, if we took $100,000 plus 80, subtracted 75,000, that would leave us with a balance of 105,000 in accounts receivable. And we know that the normal balance for accounts receivable should in fact be a debit balance, as it is for all of the asset accounts. So we can go through every account and create T accounts for every asset account. Okay? And so basically when we get done, cash balance is $323,000, accounts receivable $105,000, prepaid insurance $5,500, inventory of $323,000, building $800,000, the accumulated depreciation account for the building, again, which that's a contra asset account of $3,000, and then equipment $600,000, accumulated depreciation equipment of $5,000. All right, so that represents the T accounts for all of the asset accounts. We would then do the exact same thing with the liability accounts, only the ending balance in the liability accounts we know is generally going to be a credit balance. And so we can do this for accounts payable, utilities payable, dividends payable, interest payable, note payable, and that basically takes us through all of the liability accounts. Okay, so our ending balances in each of these accounts for accounts payable, it's going to be $140,000. Utilities and dividends payable, it's going to be $0. Interest payable, our ending balance at $131 is going to be $5,000, and our ending balance for note payable is going to be $1 million. Okay, again, because that's a simple interest note, we're not paying down any principal each period. It's just all due at the end of the 10-year period. Okay, we would do the same thing for our equity accounts, so common stock, paid-in capital in excess of par, and our dividend account. Okay, those are all of the accounts we've used so far. And so there's our ending balances for all of those accounts. And then we can finally do our revenues and expenses. So we can record all of our sales revenue transactions. Again, sales revenue, the normal balance is going to be a credit balance. For any expenses, the normal balance is going to be debit balances. Okay, and then finally, that reflects all of our revenue and expense accounts. So what we've essentially done is create a T account for each account that we've used, that we've either debited or credited during this particular accounting cycle. And so this is obviously a simplification of what happens in a real company. In a real company, you'd be talking about thousands, if not tens of thousands, of transactions that might occur every month. Okay, so this is just a simple example so that you can understand the process of journal entries, adjusting journal entries, how this flows into T accounts, and then ultimately what we would do from the T accounts is prepare what's called an adjusted trial balance. And so the adjusted trial balance is basically the aggregation of all of the ending balances in the T accounts after the adjusting entries are made, but before any closing entries are made. And we'll talk more about what closing entries are in the second part of Exercise 3. Okay? Typically, the accounts on an adjusted trial balance are listed in the following order: assets, liabilities, equity, revenues, and expense. Now, something important here. When we use the term adjusted trial balance, sometimes students try to get this confused with the balance sheet. The balance sheet basically reflects the financial position at a point in time. The only thing on a balance sheet is assets, liabilities, and equity. Okay? The balance sheet reflects the accounting equation. So when we talk about a trial balance is usually the accumulation of the balances of all accounts, including revenue and expense accounts. So don't confuse trial balance with the balance sheet. And so here's what our trial balance would look like. And so if we went through, I've already listed all of these accounts basically in the correct order. So we have all of our asset accounts listed first. Now, something to point out here, for example, our accumulated depreciation accounts are listed with the asset accounts, even though they're considered to be contra asset accounts. Then my liability accounts, then my equity accounts, and again, when we get to dividends, dividends is considered to be a contra equity account, right? Because dividends are paid out of retained earnings. They reduce retained earnings. And then finally, we have our revenue and expense accounts. Okay, and basically what we're going to do is whatever the ending balance in the T account was for that particular account, we are going to bring this forward to the adjusted trial balance. And so if you were to go back and look at all of the T accounts, for example, for cash, we would see that the ending balance in the T account is a debit balance in the cash account, a debit balance of $323,000. For accounts receivable, it's a $105,000 debit balance. Okay, so if we just move through all of the accounts and bring these balances over, what we're ultimately going to find is that once we get to the end and we add everything up, both sides should be exactly equal, okay? And that's because debits always have to equal credits. So as you're making entries into your accounting system, the debit side or the left side and the credit side or the right side always have to remain equal. And so your adjusted trial balance for your debit and credit column, those two things should always be equal. So that concludes part one of exercise 3 in the accounting review exercises booklet. In the final video, we will look at part 2 of the comprehensive practice set, which deals with closing entries and the preparation of financial statements.